Hello and welcome. My name is Thorsten Tiet. I'm the founder of Dividend Stocks Cash, stock screener to help you to benefit from growing capital gains and dividends. And this is done by making profit growth visible. In this video, we take a look at Walgreens, the pharmacy company in the United States. It's a high quality company, but nevertheless, its earnings report was a disappointment. And the stock price dropped about 12 to 13% yesterday, and today it's also slightly negative. And actual current price is $54.50 US dollar. And if we have a price slump like this, there's always the question if this is a good investment or if it's an opportunity, or if we should better ignore the stock. And in this video, we are going to look at Walgreens from a fundamental perspective, if it's an opportunity for dividend investors especially. What we can see here, we have the 5 years here, and we see that the price peak was 89 US dollar, and right now we are 54 US dollar. So it's a huge loss of the stock within 5 years. And this shows you that even high quality companies may be overvalued, and so that if you buy in unfavorable times, then you will have to suffer or wait for at least for a very long time until your overall yield becomes positive. So we'll take a look right now at Walgreens fundamental data, and here we are already on Dividend Stocks Cash. I have a little watch list, and this watch list is also Walgreens. So let's take a look. And we are going to the full chart analysis directly. And here we are. Maybe to give you the big picture about the earnings or the earnings update. It was expected that Walgreens will increase its earnings this year from 2018 to business year 2019 here by around 7 to 12% growth. But now earnings will remain flat mostly. And it's a big disappointment for sure. Countermeasures are especially extended cost saving program. It was extended from 1 billion to 1.5 billion, and acceleration of partnerships, etc. So they continue their way as is. It's not really bad. So if they are already on the right track, because the negative effects have nothing to do with Walgreens Boot Alliance themselves. They are not responsible. It's pricing pressure in the US healthcare system and unfavorable exchange rates, especially related to a stronger US dollar. And we have already new estimates and already fixed the outlook or the business year 2019. So the data is as up to date as possible. And if you take a look now at this chart, which shows the long-term growth of earnings and cash flows, you see that Walgreens is a high-quality company. It's able to increase their profits. But we see also that it's not like drawn from a rubber. There are some periods of weakness. For example, here in 2012 and 2013, we have stagnating and even decreasing earnings. We also have then here in 2016, 2017 stagnating earnings, and now once again stagnating earnings. So it got a little bumpy in the last years, in the last 10 years, the earnings growth. It's a little up and down. The trend is still upward, but there are ups and downs. And ups and downs are dangerous in case of overvaluation. This means if you bought a stock highly overvalued, that's why we go to the fair value calculation right now. For example, we've seen that the stock reached its peak in 2015 when the stock reached a price of nearly 97 US dollar. And you see that the stock was highly overvalued. Let's add all fair value calculations. You see that the stock was 97 peaked, and the stock's fair value was from 60 to 87 US dollars. So all fair value calculations indicated an overvaluation. And if you buy a stock which is overvalued, then if the company can't meet the high expectations of the market, the stock price will drop. And that's what happened exactly for Walgreens. And today we have a stock price of 54.62 US dollar, and we also see that here that the fair values are much higher now. So the situation is inverted from what it was 4 years ago. I suggest that we take the fair values of the current business year, not of the last 12 trailing months here, because they are, at least in my point of view, rather conservative. So we have in 2018 earnings per share of $5.05, and earnings will remain flat. We also have $5.05 in 2019, and regarding operating cash flow, we even have slight decrease. So the numbers are calculated rather carefully. And here we see fair values which are very close together, ranging from 75 to 88 US dollar compared to a price of 54.62 US dollar. So it's clearly undervaluation. If you wonder why the fair values are at least partly very high, especially in this period, and for example, if we take a look at the fair value dividend, it's explained by very low dividends in the past and then strong dividend increases in the latest year, if you were based on 2012. And then we have very high fair values regarding dividends. So you shouldn't take these fair values of the dividends into account here. But here it's okay, because the historic dividends based on the last 10 years, the average of the last 10-year dividend can be taken, and it was 2.21%, for example. And here it was still much lower, less than 1%, and not representative for this period. So you must always take care a little bit about which fair values make sense and which doesn't, in which period even. Another point which is very interesting for dividend investors is the dividend yield, of course. Dividend yield right now is 3.15%, and it's rather high, especially regarding the last years. In 2015, for example, if you bought Walgreens on its peak, then dividend yield was lower than 1.5%. So now it's more than double. We already got higher dividends, even higher dividends than today in 2013, when they peaked 3.54%, but today they are also rather high. So if you bought in the latest peak, in the latest dividend peak, the stock, then you were rewarded with high capital gains. You see this here also. It was a good investment if you bought the stock either in 2013, but also in the end of 2010, for example. If you stay here, then in 2013, your yield was 35% nearly capital gains only, then 26%, and in the third year, even 43%. And if you see these massive price increases, then it becomes very probable that the stock is overvalued. And then you don't need to wonder if the price goes down, if the high expectations are not met by the company. And that's exactly what happened here, and which is what is also happening right now. What's also very important, I forgot to mention, is that dividends are expected to increase, and they look pretty safe. If you compare free cash flow or earnings per share with the dividends per share, then you see here we have a still massive space for dividend increases. So it's not like CVS that you need to freeze your dividends, for example. So expect that dividends will continue to increase. How much? You can see here. Current dividend yield, as mentioned, 3.15% in the next year, or in the end of the current business year. It ends in August. 3.3% already, then 3.5%, and 3.66% at the end of the business year 2021, which of course also ends in August. Finally, I'd say that Walgreens is a nice stock for dividend investors. It has a decent the current dividend yield, and it's also expected growth of dividends. But on the other hand, please don't expect fast capital gains for this stock. It's probable that the stock needs some time until it recovers and that you will really harvest some capital gains. This is Thorsten from Dividend Stocks Cash. Thanks for watching. Bye bye.